Are you ready to win big in investing? What if the secret is to go against the trend instead of following it? How can going against the crowd lead to greater success? Financial expert Mr. Anunay Kumar will guide us through. Anunay Kumar, the screen is yours.
If I go back 24 years and I look at market on a price to book, what we have seen is 3.1 has been average price to book for the markets. If we add one standard deviation and take away one standard deviation, what the range market has told me is market over last 24 years actually has respected the price to book of 3.8 on the higher side and 2.4 on the lower side. You know what? This is a reality. Huh? 24 years, the market has always respected the range of 3.8 and a 2.4. You remember I told you in between that just remember 2003, 2007 corporate GDP slide. So this was the time when GDP corporate profits moved one way. We felt the corporate earnings are going to be consistent 22% and we disregarded 3.8 and we moved up to almost 4.4, 4.5. And look what happened after that. You'll be surprised to know in last 24 years, only 6 times market has actually come to the lower end of the cycle range, 2.4. Only 6 times. Recent one was COVID, when actually market came at the lower end. Now, what are the behaviors of the market when it does it? Every time it comes to the lower end of the curve, it doesn't spend time. Only 4% of the time it spends at the lower end. But if you are smart to enter the market at the lower end, your 5-year return is almost 40% compounding. 5-year return is 40% compounding. So ideally, what should be the case? Ideally, you should be getting the maximum money at price to book of closer to 2. Am I right? When we go between 2 and a 3, or let me put it that when we go to the upper end of the curve, closer to price to book of a 4, again, market doesn't spend too much of a time. Only 10% of its time of last 23, 24 years, it has spent at the upper end. But the 5-year compounding again is just 4%. So if I take away 10 and a 4, 14% time out of the two extreme range, actually market spends 86% time giving a return of close to 12, which is the reason that equity is a good asset class, at least 5 years of a vision that you should carry, and a decent average return could be between 13 to 14% is what you should be looking at. Because market actually spends 86% time delivering that kind of a return. Now, where are we today? Today, we are at 3.9. So we are not cheap. We are not cheap anymore. Are we too expensive? Answer is no. We aren't. But the broader part of the question is, if this is the behavior that the market gives, now how are you all reacting? How are the investors reacting? What did I say? Less than 2 price to book, you actually would get 40% return. Above 4 price to book, your returns are only 4%. But look how the monies have flown. Closer to less than 2 price to book, your actually flows are 0. You are in the negative flow. You actually are taking the money out. This is a typical investor behavior. The moment markets goes little expensive and goes between 2 and a 3 on a price to book, when your returns expectation are close to 13%, the flows we have seen is 36% of the flow come during this period. 36% of the flow. But the maximum flows come when the markets are between 3 and a 4 on a price to book, which is closer to topping out. Almost 56% flows come in that range. And then the beauty is even 8% flows come when the market goes beyond 4. The market is super expensive zone. Still the money is pouring in. This is a typical behavior of investors. When they should be putting the money in, which is closer to price to book of a 2, he is not interested. On the contrary, he's taking the money out. He's stopping SIPs. And the time when he should actually be holding and exercising caution He's still giving me 56% to 8%, almost 64% money is coming in that expensive zone. This is a typical behavior that we see of an investor. The stock market is a story of cycles and a human behavior, and that is responsible for overreactions in both directions. We do react in both the ways. When we should be putting the money in less than two, we actually took the money out. That is the behavior that one notices. Look at this other behavior. Doesn't matter. This black line is nothing but a 3-year, 3-month moving average of redemptions. Look at the Nifty. Nifty going up, Nifty coming down, going up, doesn't matter. Our redemptions are high on the up also, our redemptions are high on the low also. These blue bars are the redemptions. We are taking the money in every time. Whether market is going up, market is coming down, doesn't matter. Either it is the greed which makes us invest more in the up market, or it is the loss aversion part that makes us take the money out. But the beauty is, rather than staying in the market, we still are in the business of trying to time the market, and hence the redemptions are seen.
Thanks for your detailed answer. If you have any doubts regarding this or any other financial decision, don't hesitate to book an appointment with our financial experts. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like. If you are new to our channel, please do subscribe. Thanks for watching.